Good morning. Welcome back to the Broadcast Retirement Network. This is BRN AM for Wednesday, August 7th, 2024. And our top story today, target date funds continue to evolve. And joining me now to discuss this and a lot more, Matthew Brenner is with Missionsquare Retirement. Matt, it is so great to see you again. Thanks so much for joining us on the program this morning.
Jeff, it's a pleasure to be here. Thanks for having me.
Yeah, we're going to talk target date funds, and let's start with some basic questions. How has the target date fund universe evolved in 2023 and 2024?
Yeah, thanks. The target date fund universe, there's really been a fair amount of innovation across the industry over this most recent period. I would say that the main headline is really about managers who've been looking to incorporate income into their target date funds, and income can come via annuities, might be some other mechanism. I would say it's still early days for those efforts, but those efforts have gotten a lot more attention following the passage of the Secure 1.0 legislation. I'd also say that target date funds that look to include both passive and active allocations, those continue to be a trend. And then some major target date fund providers have started to incorporate illiquid alternatives into their funds. And more importantly, there's starting to be some differentiation between the implementation of target date funds in 40 Act funds and those that are built as collective investment trusts.
Let's talk about, I want to get to all that and ask you specifically about what you laid out. But as a follow-up, let's have target date fund managers, the brands like your brand, have they evolved to the point where they've begun incorporating outside managers? And by that meaning they're not a Missionsquare managed fund. So the underlying investment, have they started including outside managers? Is that a trend?
Maybe to a point. That's a little still more limited within the broader target date fund universe. And I think it's safe to say that those managers with the largest scale have historically been less likely to include a non-proprietary fund within their own target date fund complex. But for those managers that are offering hybrid funds that may balance active and passive, there are some who are more open to selectively using third-party managers.
Matt, you mentioned the inclusion of alternatives. Just to kind of follow up on that, how much progress in terms of allocation percentages and weights has been given to the inclusion of, for example, private equity, hedge funds, private debt, direct real estate in those allocations? Are you seeing, in terms of from your perspective, are you seeing greater increase in the allocation percentages there?
Yeah, well, to start, the efforts within the industry to figure out the different ways that they may be able to incorporate alternatives into target date funds, that's definitely increased. There's a lot more focus on it than there certainly was 5 years ago. Now, there's not one way to do this. It's clear that there are multiple ways that managers who are looking to include alternatives may be able to do so. And so this is actually an area that's really primed for continued innovation. I'd say there's been more progress on customized target date funds for larger plans than there has, at least right now, for off-the-shelf commingled funds. But even that's starting to change as well. I'd anticipate more of a focus on real estate first, followed by private equity and private debt. There may be some challenges in including hedge funds that would lead managers not to prioritize their inclusion in the shorter term, but clearly that will be a place for innovation down the line as well.
And Matt, you mentioned collective investment trusts, and we're still waiting on the inclusion of CITs in 403B plans. That's a whole nother show because there has been legislation. We'll get to that probably in a future date. But how about the creation of target date funds as CITs? And I'm thinking about 401k, 401a, 457B plans?
Yeah, most of the major target date fund providers at this point are offering their funds as either 40 Act funds or CITs, and sometimes both. Um, it's important to note there are differences in the structure and the regulatory approach around both of these. And in particular, there are the liquidity limits in a 40 Act fund that may make it hard for a target date fund provider who's looking to include alternatives in order to do so. And for a long time, those managers that had both CITs and 40 Act funds, they tended to structure their CITs as clones to their 40 Act. The overall trend in the marketplace, as we know, is an ongoing shift from 40 Act funds to CITs. That's likely to continue. And as that adoption of CITs increases, then I anticipate that there's going to be more utilization of the CIT structure itself. And so if that happens, it means it leaves that liquidity issue behind a little bit. And so that managers that have both 40 Act funds and CITs, differentiating between the two versions of those funds. I think we're very much in the early innings on this, but it is, in limited cases, already starting to happen.
Yeah, and I like, by the way, that we're in the summer and you used a baseball analogy. Matt, I need to take a very quick break. When we come back, we're going to talk about personalization in target date funds, and is it an either or when it comes to managed accounts, and a lot more. You're going to want to stay tuned right here on BRN AM. Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device. Well, Matt, thanks so much for staying with us. Really appreciate you hanging around for segment number 2 this morning.
Thanks. Looking forward to it.
All right, let's talk about personalization, because I think there's a lot of people inside the retirement industry where they attest to the personalization of managed accounts, the ability to personalize your portfolio allocation based on specific needs, risk tolerance, et cetera. And then there are other people who talk about the ability to personalize or focus on the target date fund. And I guess my first question to you is it an either or? Do you have to pick either managed accounts or target date funds, or can they kind of work in concert with one another in the plan?
Yeah, I mean, plans can and do offer both managed accounts and target date funds. And there's space for both of them. I mean, the tent is big enough to accommodate both the traditional target date fund as the QDIA or the managed account. But when it comes to a QDIA, plans do have to select one over the other. I would say to this point in time, target date funds have been the preferred selection. There's no guarantee that dynamic will continue. I think, in target date funds, a lot of the times there's one option per a vintage plan. When it comes to personalization, obviously it's personalized to every single participant. And so at least so far, I think that dynamic has led many plans to select the QDIA that is, that's a target date fund. But, things may change.
Yeah, and by the way, we could be in, as you stated before, we're probably in the early innings of that, even though the Pension Protection Act was in 2006. We're the retirement industry kind of glacial as it moves and evolves, but still a lot of positivity happening. Matt, I want to pick back up on something you talked about at the beginning of the program. That was active versus passive, and this is a debate that I think it exists before you and I were probably even thoughts in our parents' eye. This talk about active managed versus passive managed, but Is it a bit more nuanced when it comes to the target date fund? It's not just active or passive.
Yeah, Jeff, I agree. And to start with, in target date fund, the whole notion of a passive target date fund is very misunderstood. So if we take a second and just think about equities for a moment, the S&P 500, it's the most widely known index. It's very straightforward to understand. And if there's a passive approach to that index, it really just replicates the weights of the index as closely as possible for the lowest cost possible. Target date funds, by contrast, are asset allocation funds. And there is no industry-wide agreed upon weighting for the asset allocation in target date funds. Nor is there consensus on a glide path, which of course changes the asset allocation over time. So while results may certainly vary, it's a general principle in asset management that the asset allocation is the primary driver of performance for any broad portfolio or pool of assets. So if you look at it through this lens, there really is no such thing as a passive target date fund, since it's impossible to structure a passive allocation when there is no agreement as to what that allocation actually is. Passive target date funds really refer to the passive management in the underlying building block funds. And for those plan sponsors seeking a low-cost solution, that type of target date fund has been a common choice in recent years.
Matt, you mentioned allocations, and one particular segment of a target date fund allocation is often cash or money market. And your firm is very well known for its stable value fund. Are you seeing, as far as the trends, the inclusion of stable value as an allocation, as a replacement, or as a complementary asset class to the aforementioned money market or cash fund?
Yeah, there is some usage of stable value within target date funds and advisor constructed glide paths, but it hasn't yet been adopted more broadly. Uh, I suspect that this relates to the structural issues that stable value often cannot be included into a 40 Act fund. So to the extent that target date fund, commingled target date funds have either largely been 40 Act funds or the CITs are structured as clones to those 40 Act funds, that may be a limitation, at least to date, as to the adoption of stable value. I would say that as more providers embrace the differentiated usage of CITs, I'd anticipate more usage of stable value in target date funds due to the income and volatility benefits that strategy may offer.
Yeah, and those stable value funds are a key asset class in so many retirement plans. So advisory firms are already doing the due diligence around those particular products to make sure that they are safe and includable in the plan. Last question, Matt. There's so many more questions, by the way, that I would love to do an hour-long show on target date funds. But I want to pick up where we started. And one of the trends you talked about was retirement income. How are manufacturers of target date funds including the concept of a paycheck for life in these target date fund structures?
Yeah, this area has probably had the highest focus within target date fund space over the last few years, largely due to the passage of Secure 1.0 back in 2019. Some target date fund providers are offering entirely new fund families that embed an annuity or other type of income generation right into the glide path. I think there are others who are asking participants to select whether they want this feature, and those opting for the quote unquote paycheck approach are funneled into a solution that will provide some type of income, whether it's guaranteed income or variable income. It's still early days for these products, and participant education is going to be of utmost importance because once a participant opts into this type of product, they will be paying either implicitly or explicitly for that future income. As a result, they'll need to understand that if they decide to move their assets at a later date, they might be sacrificing that income stream in retirement and not receiving a feature that they had been paying for with their target date fund investment. I do believe that these products can serve an important role for people requiring income in retirement. So our entire industry really has to commit itself to educating plan participants and sponsors on how these products work, and the long-term implications for making such investments.
Yeah, and I would agree with you on the education side. There's clearly demand there. Every time you talk to a participant or you see surveys, they want a paycheck for life. The plan sponsor wants something so that people can retire and they can continue to develop and retain employees. Matt, this is going to be a continuous conversation. Really appreciate you coming on the program, and we look forward to having you back again very soon.
Jeff, always a pleasure. Thanks for having me.
That wraps up this episode of BRNAM. Have a topic of interest? Someone you think we should talk to? Drop us a line. And don't forget, for all the latest curated news and lifestyle, wellness, finance, tech, so much more all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? Then visit our website. Hey, we're back again tomorrow for another edition of BRNAM. We'll have a very special guest and another important topic. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.